Well, good afternoon, everybody. Thanks for joining us for the JS Mindset Weekly Call. My name's Denny, and today is Saturday, May 9th, 2020. And on the call today are Jim Sinclair, Bill Holter, and, of course, our Dave. Little by little, poco a poco, Americans are beginning to understand that a lot of money has been created and spent in the last 45 days. And it's pretty incredible just how much money has been borrowed and distributed without a lot of accountability to repay it. To think that $2 to $3 trillion has been created out of thin air, distributed to individuals, distributed to small businesses and large businesses, and the loan documents don't really memorialize much of a responsibility to repay it. And of all people, Paul Krugman's suggestions appear to be coming to the table. I went back and found a piece that in 2011 he suggested that higher inflation would help to ease the private debt overhang, which would help promote economic recovery, which would in turn raise revenues and help the fiscal situation. We'll see. If that really is the case, we're about to get hammered with a lot of inflation. And if you're watching the stock markets, you're probably wondering how in the world that it can be where it is in the type of shape of the economy we're in, not the least of which of 30 million folks on unemployment, the markets go up. Does it make any sense? Not really. Before we get to the questions, please be aware that in our conversations today with Jim and Bill and Dave, it's always important to remember we're not giving anybody investment advice. I retired from that trade. What we're trying to do is share our own personal perspectives of the economic world, and you can choose to add it to your own perspective. You can choose to ignore us like our wives do. But in the end, we want you to be prepared for what might certainly be some very, very trying times, and they're getting closer. Jim, you're the first pig to the trough.
Uh-oh.
We're told that there's an inverted debt pyramid that is so huge and has so much overhang. We can see it with our own eyes now. 2 to 3 trillion were added in the last couple months. How can the currency genies keep the thing from tipping over? Negative rates are going to dry up new money, and there's just got to be a panic over the horizon, if not even right upon us.
Well, I don't think that's in the playbook for right on us. I think we were in a position where we were entering into a very serious banking crisis when the condition of the repo market and the condition of the euro-dollar market, that's just a dollar in Europe, not a euro-dollar market, the very shortest-term lending facilities were starting to freeze up. Okay, and along came the pandemic. And don't read me wrong, but I'm not suggesting the pandemic was anything else but an escape virus or something of the sort. But the timing could not have been better because we are really out of tools, fellows, when it comes to being able to liquefy an economy through standard monetary measures. We've used them up. And the method that's on the horizon now and has been well planned by, I believe, a man who has the best understanding of bankruptcy of most modern leaders, our present president, would not break the playing board. In other words, you have to keep the board together. The board would have exploded under a monetary banking crisis, which was in the making. In fact, it was here at about exactly the time the virus pandemic started. So in what you describe as sending out, making loans that really in most cases do turn into grants and do not have to be repaid. For instance, if you as a business had 100 employees and you borrowed funds to pay all of those 100 employees, and you're one of them, as long as you can produce checks showing that your employees were paid, you have no obligation to repay the loan. It will automatically turn into a grant. And the amount of money that has been poured in the shortest period of possible time is totally competitive with what was done in 07, 08, 9, 10, in the period when we went into a banking crisis due to failure of derivatives. Now, all of those derivatives are out there times orders of magnitude. They never stopped. The profitability to the derivative manufacturer was simply too great, too much of a temptation to turn away from. So we had a moment when a monetary crisis and an epidemic existed at the same time. It's fortuitous, in a sense, that this kind of money was put in more into a mainstream than it was put into the 1%, but of course some was. Because very little of that is ever going to be paid back, and we're moving now into the only thing left to promote the feeling of a recovering economy, which is fiscal spending. And fiscal spending is different than monetary stimulation. Monetary stimulation is the creation of liquidity, but when you're down to zero rates, you're getting to a point beyond which you are so liquefied it would have no effect whatsoever. But to get shovel-ready jobs, or to get shovels to make jobs ready, is fiscal stimulation. And I'm sure that what you're going to see is trillions upon trillions of dollars being spent on transportation, highways, bridges, dams, all of that makes up for the rotting infrastructure that we actually do have. I mean, it's embarrassing. Even Dar es Salaam in Tanzania looks more modern than as you drive in from the airport than does New York City, which is quite a mouthful. So the game was not to let the playing board break, because if the playing board broke, that is the structural foundation of the economy, then even fiscal spending couldn't bring it back. And our present president either stays in office or the United States turns into something that we never imagined could occur. And that would be very much like the South American countries that have gone through currency collapses and hyperinflation. Now, that will occur, but it won't occur like a sandstorm. It will continue to build into the 2020 and 2025 period. And the amount of money to be created now will have an impact on the economy in the manner whereby people are hired to build things and to repair things and to do things. Now that is the opposite of the previous theory of filtering down, bubbling down, that by making the rich richer, you'd make the poor less poor, because it didn't work that way. And now the thesis is bubble up. That is to get as much money into the hands of the working class as possible, as fast as possible, through fiscal stimulation. And the stock market, and I think the word market should be taken out of our vocabulary, because, gentlemen, there is no market in anything, okay? There are numbers in cyberspace created by computers. And worth and value have no relationship whatsoever. Or you wouldn't have Tesla selling worth the total capitalization of every other car company put together. Not that they're not making progress in what they're doing, but you have to say worth and value. Is it really worth what it's valued at? Where is the value to equal worth, as the equation normally would require a much closer relationship than one that simply exists, again, in cyberspace. So we've killed markets by making them so technologically perfect that they've lost fear and greed, and that really is the function of an economy. It has historically, throughout the history of man, built great societies and had built this country we're in now. And we became so greedy as it was that we made the huge mistake of exporting our supply chains, where we don't make much of anything anymore. We don't make the integral parts to even that which is made here. We assemble from all around the world, leaving only one possible way to create another Potemkin city, is defined as not real but looking like. And that is to get people to work on building the infrastructure of the country, which is in outrageous disrepair. And all the money coming in now is going to come in to the many rather than to the less. And you realize that there are those who will always be Republicans and those who will always be Democrat. In my house as a child, if you use the word D, you would be thrown out of the house. And the truth of the matter is, presidents are elected by a very small percentage of votes, which tend to move from party to party, and that is between 5 and 15% of the voters. So the election coming up is critically important, both economically, politically, socially, and military-wise. We may transition into an environment which you would have thought absolutely impossible, represented, let's say, by the Squad, and represented even by who's running as a Democrat for the office of president, or who is attempting to have that position. Trump knows he must be reelected. And there's only one way. He's got to take spending to a level that we have never seen before. And the spending cannot be wholly devoted to the 1% banking and commercial entities, but has to be going into hiring many people to do many jobs at significant salaries to be his road to recovery, which will be advertised as never seen before, and he used the experience that we went through in 08 and 09 to say, well, where did all that money go? You want to see where this money's going? Take a look at I-95. That's where you find it. So you're going to get that type of spending, and you're going to get hyperinflation, exactly as Bill has explained it. That which you need will go up in price. That which you don't need will disappear in price. In other words, meat will cost more, and your Tesla will be worth less, especially a used one. And that's the birth of hyperinflation. And the fire underneath it is both past monetary thesis and present fiscal, to take the center stage of the spending that's going to be done in order to create a market, a stock market at or back at old highs in order to get elected. Now, that's the desired scenario. And it has a very real chance of coming around. And what the fact that the virus and the banking crisis exploded at the same time, the virus being much more spectacular, taking all eyes off what was happening in short-term money and what was about to happen to interest rates, and actually stopping the demand for money. There is no other way. Actually, totally brilliant, actually, if anybody thought it out, because the demand for money in the short-term market, with banks not trusting each other, and in the highest probability, if you look at the quote on Deutsche Bank, you'll know it's very much involved with Deutsche Bank. And there's only one way to take care of it, because you could pour all the liquidity and you want it would only go into the pockets of those who feared situations like Deutsche Bank. So you stopped the demand side of the explosion, which was taking place in the liquidity markets, in the banking markets. And you poured money in that doesn't have to be repaid. In the main, that money does not have to be repaid at all, period. That's why the loan documents are generally almost missing.
Well, it's almost indeed that this is helicopter money then.
This is definitely helicopter money. Most all of that money will never be repaid. It was never meant to be repaid. It was meant to keep the playing board from shattering. Playing board is the underlying hope and confidence of a general public.
Jim, that was the best 10 minutes I've heard in a week from you. That is really good stuff, brother.
Well, it's exactly what's happened, and of course it will lead to a lot of people considering conspiracy. But the truth is, and you have to ask yourself this question, are we at war with China? War in the future is not going to be boots on the ground except proxy wars. I don't think Beijing wants New York. I don't think anybody wants New York. Okay? It's totally bankrupt. The dirtiest place you'd ever want to see. You might as well be in behind Horwith Station in Calcutta. The place is in disrepair. I don't think there's a prerogative desire for property in the terms of what we normally saw. Hitler wanted everything. Only thing that China wants is power. Power is money. Money is not currency. Money is that which you hold that has the ability to maintain buying power. That is what money is. Currency and
Jim, let me pitch over to Bill here just a second.
Hey, Denny,
Bill,
let me chime in on what Jim said.
Please interpret.
Now, maybe after 3 or 4 years, our listeners can understand why time after time after time Jim has said there are no markets. And it's in your face now. I mean, there is no economy. You have massive unemployment. The economy's at a standstill, and the market's gone higher from whatever date it was toward the latter part of March. The point.
Well, Bill, let me push on that just a little bit. I'm not expecting consumer spending to recover to pre-COVID levels. Without consumer spending getting back to those levels, there's not enough gas in the tank, and all this money that's been printed and distributed shows that the helicopter money is in full-on mode. I see a currency crisis coming pretty soon. Do you?
Well, markets are going higher because they've crammed money into the system. They've crammed currency into the system. Your real clue will be once the metals. Once you start seeing, we're already seeing food inflation. We're seeing inflation, but once the metals finally break free from paper trading, and you'll know it when you see it. I mean, you're going to see just huge moves. That's your currency crisis. It's not so much a currency crisis, the dollar versus the euro, or the dollar versus the pound, or the pound versus the yen, or what have you. Yes, there is a problem. The synthetic short that we've talked about many times, the synthetic short where trade deals are priced in dollars, they have to settle in dollars, and that created artificial demand for dollars. And a lot of the emerging markets are having a problem because there aren't enough dollars around for them to actually settle their contracts. So there's your currency crisis. But the final straw is once gold and silver become no offer. Once there's a failure to deliver, that's your true currency crisis, because that means that all currencies are in the toilet. And before we go any further, Denny, I got a question for you. How was your first week of retirement?
Well, it was interesting in that when you disconnect from 50 years of work, your body sort of keeps in a rhythm. I still got up at 4 o'clock in the morning, Bill. I was able to sleep till 4:30 by the end of the week, but the days are still full. I'm able to read more. I'm able to do more. Now, I'm taking your question dead seriously. It wasn't what I was expecting. I was expecting falling into a void, and what I've done is I've fallen into a place where I can get caught up on things that are important to me, which is reading, I just got back from a grandson's birthday party. I have time to do stuff now, brother, and I didn't, I never had that. But
I figured with you being around the house all the time, your wife would be ready to beat you at the end of a week.
I tell you what, if we'd have started this call 35 minutes ago, you'd have found me in the crawl space. So anyway, life's good. I still got the plumber in me, and I'm still going. Hey, I'm going to jump over to Dave here. Dave, I'm struggling to keep a couple things in perspective. And I sent this to you a little bit early because I thought that with your common sense you could help. The difference between credit inflation and currency debasement. I think they're certainly related, but there's a difference between credit inflation and currency debasement. You want to take a swing at this one, David?
Let's see if I can get this even close, Danny. Credit inflation, the Fed hands out money for zero interest rates, most of it going to favored businesses. Their stock prices go much higher on zero interest and free money to cover bad business bets. As we briefly talked about before the show, Bill, we've seen this since 1987. It seems to be just the way it goes. If you want to look at currency debasement, the paper money I had in 2001 would buy a nice house. If I had that same money now, it wouldn't buy a nice house. In 2001, I could take a very small amount of money and buy an ounce of gold. Now it takes a lot of money to buy an ounce of gold. So, as I look down this double-barrel shotgun, it's, like Jim has said, Bill and I have said, we've all said that you're going to see, and again, inflation, and again, monetary problems, as you guys have brought up previously, could change, I don't want to say the value of the dollar, it's going to change the value of gold against all types of paper money. We've recently seen pretty good swings, especially in the Japanese yen. And you see where all of a sudden the yen wants to get stronger. Well, the dollar's still at par. So as we sit here and we look at this, and you said we've added trillions of dollars. It took 200 years for the United States to get to $1 trillion in debt. Now we could add that in a blink of an eye. So, again, the inflation is going to encompass things that we really need. And again, when we say really need, food is probably a good bet. Things we don't need, I don't think there's going to be a bid for them because nobody's really going to want them. But I like to read something, and this will give people something to chew on. The inflationist, encompassing the entire financial establishment, failed to see the end of fiat currencies, but a rational and objective analysis coupled with the evidence tells us that the sudden and rapid escalation of monetary expansion aimed to ensure financial assets do not fall will lead to the destruction of the dollar as the world's principal medium of exchange. And with the reserve currency gone, it's very unlikely that other major fiat currencies will survive. So that's probably the only way I could sum that up. We're to the point where, does anybody really think the dollar is a store of value when they could just pass it out? I mean, you just get the checks in the mail. We've discussed this in earlier weeks. If this is all you had to do to make an economy go, then I can't believe we ever had a recession before in the last 5,000 years, because this isn't the first time this trick has been tried. We'll see how it ends. I don't think it's going to end well. As we said, when we talked about people pulling out of the stock market, what are they doing with their, you used the word money. Well, it's not really money. It's a digit in an account that isn't money because, as we know, money is gold or silver. And as I said, in 2001, when Bill and I were working together, just prior to 9/11, gold was at $270 an ounce, $265, whatever it was. You literally, for a couple $100, could go get a gold coin. Now, it takes you, if you go by the average person's paycheck, a week and a half to be able to come up with a gold coin. So what's happened to the value of money in the last 20 years? Bill, what do you think?
Well, David, the question is, if you can create something for free, something for nothing, what value can it have? And, I mean, if you look at gold versus fiat currency, there's a real cost to produce a 1-ounce bar or a 1-ounce coin. I mean, you've got real capital, real labor, real equipment. There's real effort to create 1 ounce. Whereas there is zero effort, and all you're doing is pushing a button to create $1 trillion. So, and to the question that was asked, the difference between credit versus currency inflation, think of it this way. As long as credit's available and credit's easy to get, people can borrow and people can buy assets, and that act of buying takes supply off the market and pushes the price up. So there's your asset. I mean, there's your credit inflation. Whereas currency inflation is once confidence starts to break, and once confidence is broken with fiat currency, people try to spend it. It's like a hot potato. They try to get it out of their hands as fast as possible. So what happens is the currency buys less and less. That's a different type of inflation. Nonetheless, it's still inflation. It's still the same result. It costs more. It takes more dollars to purchase a house or to purchase a hamburger or what have you. But it's two distinctly different types of inflation.
Jim, you're back up. We're starting to see bankruptcies in the big retailers. So in a way, it looks like they're going to be losers for the first time in a long time. Jim, if they really let businesses fail without stepping in to backstop them this time, no matter who in the world they are, there might be a chance for the economy to return to a firm foundation. In other words, we're back to a time of winners and losers. I believe winners and losers is what it's going to take. But I'd appreciate your perspective.
Well, I think that will come in time. But right now, the operative word phrase is to maintain the playing board. If a bankruptcy, if it is in fact a situation where there's a global bankruptcy, not just the U.S., but every other major nation, in terms of sovereign debt, internal debt, and asset earnings capacity, etc., then a repair must come immediately or appear to come immediately before total confidence the playing board is lost. So you would expect that if you were in the position of the present president and you were looking at what might be the next president's method of economic administration, you'd feel almost divinely required to be reelected. And you'd throw all rules and all common sense to the wind. And you wouldn't wait for the major retailers to go broke. You would repeat the General Motors scenario, where then you put money in and you take shares out. So you begin to nationalize. 1 second while these guys do. 1 second, please.
We're still with you. If you're listening, we had a little bit of a break here to deal with some puppies.
Jim had to hit the mute button on the puppies.
Yeah, I think so. I'll tell you what we'll do. We'll come back to Jim, and I'll go right to you, Bill. I sent you this a little bit earlier because I've never understood how you guys did the calculation. But you've done this calculation for the price of gold, what it would have to be to balance the books. The gold standard in the U.S. backed the Fed by approximately 50% back in the 30s, 27-30 era. The real number, I think, is 54%, but 50% is easier for us to calculate. So suppose the Fed's balance sheet is $6.1 trillion right now. And even though the quality of those assets are suspect, just looking at the Fed, Bill, what would you suggest the price of gold should be at this point if we just backed it at 50%?
Okay, I got to do this math in my head. I did the calculation on 21 trillion. That was the total debt.
Well, 21 trillion is fine.
Okay, so that was the debt. That was not the Fed's balance sheet. So if you use 21 trillion, you come up with $87,000. So if you take the Fed's balance sheet at 6 trillion, that's 30% of 87. It's 30% of 20 trillion or 21 trillion.
So you're talking about $29,000 an ounce then?
You'd be looking at 8,700 times 3. So yeah, 28,000. And if you're using a number of 50%, 14,000.
Okay. Now that's where we were in 1927 and into 1930. That's all they backed was about 50%. So that shows you even in a de minimis calculation of just the Fed debt, not the total debt, but just the Fed debt or the Fed's asset sheet, that's an incredible jump.
Jim, sorry about that.
That's all right. Hang on just a second, Jim. So just the Fed side of things, Bill, we're in the 25 to 27,000 range, but the full money is $87,000 an ounce.
Well, it's more than that now because the calculation was on 21 trillion. Now we've got to be at 25 trillion. So it's over 100,000 now to pay the debt off.
To balance the balance sheet.
Right, to balance the balance sheet, exactly, Jim.
Bill, before your puppy started...
Number.
Yeah, it's a stupid number for sure.
It's a stupid number, but it's going to be way more stupid because you can pretty much bet by the end of this year the total debt is going to be in the high 20s or sniffing $30 trillion.
Jim, before you had to deal with the wolf pack, we were talking about winners and losers and if they were going to allow the economy to return to winners and losers. And you said, you started off by just saying they're going to have to maintain the playing board, and you can develop it from there.
Okay, well, basically the playing board, what has happened because of the coincidence between the virus and the second collapse of the banking system. The playing board still exists. If the banking system went down for a second time, confidence would be gone. Right now, people tend to believe America will be made great again. That belief must be fostered by action. And monetary stimulation right now has no significant ability to deliver that. Yet fiscal stimulation has that ability, and that is a massive program of rebuilding the infrastructure, bridges, tunnels, roads, highways, you name it, in the U.S. And that must be undertaken. It must be undertaken. The limiting factor is that the minute that would have any success, guess what would start up again? The monetary problem and the short-term interest rates, or interest rates beginning to rise sharply. So it has within itself a self-limitation, but it must take place because it is seen as an imperative by those who disagree with the squad about how a country should be run. So in one sense, that disagreement is not to be considered without foundation and basis, but here's where the means, where there be a lack of justification between what would be used to maintain confidence and what it will do, what the product of that will be. That's the means versus the ends. Now, what will take place is we don't watch the money indicators as we used to. There was a time when we watched the M figures like an eagle's eye, and as monetary aggregates would change, so would prices for shares and bonds, etc. Now we're watching the D number, the deaths, and as the D number goes down, the stock market will go up. If the D number goes sideways, the rhetoric will sustain the illusion of a recovery. And the period of time that needs to be maintained is not very much over 100 days, under 200 until election. And everything that can be done will be done in order to begin or to maintain the process that already has begun, free money, without the need to be repaid. So the creation of funds and the utilization of funds will be somewhat different. Creation of funds will always remain the same. You buy your own bonds. It's called debt monetization, and it always results in one thing: inflation from modest to major. And it's going to require every effort that can be made by those who wish to maintain their position, increase the position and in control of the House as well as the Senate, in order that the system may actually continue forward with some semblance of the past. The ability to do that is really is an assumption that you can blow air into a balloon for all eternity without hearing a loud explosion. The balloon is debt. The debt balloon, although pierced in many ways, will continue to accelerate, growing bigger over the balance of this year into the next. And the means I've already explained will be, rather than sending money to the banking system, money will be spent on building things, repairing things, and that will create employment. It's not going to bring employment back to where it was, and we're not really getting the numbers. I can only imagine what Mr. Williams' numbers of unemployment percentages now is probably double the 14.7. So during that period of time, you've got to keep in mind that the dollar is measured against gold, not the USDX. That's a big farce. The dollar measured against other currencies is only a measure of everything going down at once, so that currency, which is dropping with least speed on the downside, would appear in the index as if it was going up. And people look at the USDX and think that's a measure of the dollar. It is not. The measure of the dollar is the price of gold. That's because it's measuring the dollar's ability to be a standard and a storehouse of value, which it is not. So we will continue what we've been through and accelerate the spending and the accumulation of debt, and that is simply impossible. That will neither rescue economies nor have any positive impact that's sustainable on general business. But it might get the present president reelected. So you've got all these things going on at once that are like separate shows. Do you really want the squad running the country? Do you really want a fellow hiding in a cellar who probably is a bit too old or too affected by age to take over running a country? Or do you want a man who's most experienced at bankruptcy, attempting to take the entity through bankruptcy by two resets, by creating a currency only to be traded between central banks, which is a cryptocurrency, and to allow gold, and it's not as if he allows it, but to invite it is more like it, to seek to do what it normally does, and that is to balance the balance sheet of of whatever is considered to be the reserve currency. Except in this case, China and Russia control that market. So you have so many. You basically have a hunter's stew of FUBAR, economic, social, and political mixture.
Now stop trying to cheer me up.
If money's free, what's it worth?
What's it worth, exactly. David, this week...
The dollar could remain strong in terms of USDX. And
Tall
everybody say, hey, you guys said that it's all going to disappear. Yeah, it is all going to disappear. The whole thing's going down. Except the fastest down is the disappearance, okay, in South America and in Africa. The dollar versus those are strong. But that's not dollar strength because it doesn't represent the ability to be a storehouse of value, a storehouse of your work and your effort, to be able to buy for you from year to year the same amount of goods and services. It's quite complex, but in truth, in a horrible situation, the least horror just occurred, believe it or not.
David, this week I started... I remembered Upton Sinclair, who he was about 40 years old when the Great Depression hit. I think he was born in the 1870s. But he wrote the book about the jungle, which exposed labor and sanitary conditions in the meatpacking industry. And, of course, here we are with COVID now hitting the meatpacking. And I got to thinking about what you'd said, but I came across this quote, David, that in 1927, Upton Sinclair just said, the little guy is really going to get screwed in this one. But here was the quote: "The Federal Reserve System is at work. A device of the big Wall Street banks is supposed to be government board, but really just a committee of banks who had the power to create unlimited paper money in times of crisis. The money was turned over to the big banks and in turn loaned to them or loaned by them to the big industries whose securities they held and had to protect. So whenever a panic came, the big fellows were always saved and the little fellows went to the wall." David, that was 93 years ago. But it sure doesn't look like much has changed. Upton Sinclair nailed it then, and by golly, I don't think much has changed, Dave.
There's nothing new under the sun.
I think it's changed. I'm going to put a vote in for change, and
all right,
we'll discuss that later.
Yeah, let me hear from David, and then I'll come right to you, Jim.
Well, again, as we said before, the call. We've watched this since 1987. Pam Martinson from Wall Street on Parade really did a good short article on this, and I'd like to just read a little piece of this, because this had to be sold to the public as it was for their benefit. Now she's referring to Larry Kudlow, and these are Larry's words. "This package will be the single largest Main Street assistant program in the history of the United States. Phase 2 delivered the sick leave for individuals, hourly workers, families, and so forth. Phase 3, a significant package for small businesses. Loan guarantees will be included. We're going to take out expenses and lost revenues. And finally, I want to mention the Treasury's Exchange Stabilization Fund. That will be replenished. It's important because the fund opens the door for Federal Reserve firepower to deal in a broad-based way throughout the economy for distressed industries, for small businesses, for financial turbulence. You've already seen the Fed take action. They intend to take more action, and in order to get this, we have to replenish the Treasury's emergency fund. It's very, very important. Not everybody understands that." Then he goes on to say, "In fact, when the dust settled, the bailout of Wall Street was structured," and this is, again, Kudlow, 4 to 5 years was structured to run for 4 to 5 years, while the extra $600 a week added to unemployment claims for workers was going to last 4 months. So we're going to have to see what happens here, Denny. Again, I've watched this from the little guy's perspective and, as you said, the big guy's perspective. Personally, I don't want to see anybody bailed out. I am so tired of bailouts. I'm so tired of the excuses on why we have to do this, because it's going to save this, it's going to save that. I grew up in the world where capitalist meant people won and people lost, and everybody had to just deal with it. We made these big deals about, nowadays they bring up snowflakes, so they don't want winners or losers in the kickball game or in the dodgeball game. Well, what are we doing here?
Everyone gets a trophy, Dave.
Right. If Hertz is broke, let him go broke. If the malls are broke, let them go broke. I really don't care. I'm tired of excuses. Every single couple years we go through this. We've got to do this to save the country. No, we don't. We're killing the country. We're killing ourselves. I'm looking at people who are either too afraid to go to work, don't want to go to work. If they go back to work, they're not going to make any money, because if you're a waiter or a waitress or a bartender, you're never going back to the way your life was. They could give you $600 a week till you're blue in the face. It's never going back to the way it was. I'm a pure capitalist. We have so much excess in our system. We have Shake Shack trading at $50. It's a hamburger joint. It's a $25 hamburger joint. Please let it go out of business. Tesla, please let it go out of business. And I'm not picking on any industries, but hey, if we let the bad trees in the forest die, good ones will replace it. It will take some time, but if we keep feeding the bad trees, good trees are never going to die. We need to let these old industries die. If the airlines go broke, somebody will buy their planes and eventually fly them. Is it going to cause pain along the way? Well, we seem to have this pain every single, 8 years, 10 years. I mean, it's another bailout. Oh, first it was 9/11, and we had to because we were attacked by them. Then it was the next financial crisis. It's like there's always an excuse. Let them all go broke. Let them all go broke, and let's see what happens, and maybe we could return back to a sound economy. I know it's not going to happen, but that's what should happen, in my opinion.
Well, let me address the plan, okay? Not the should. And I agree with you completely, David, that the safety valve of capitalism was the recession. And when things became overdone on the debt side, which ran about every 4 years, the safety valve would blow, steam would come off, and you wouldn't send the hot water heater through the roof like a missile. Well, the hot water heater is off, and it's going through the roof like a missile. And you're dealing with what exists at that point in time. So right now, there's a military saying FUBAR, which means screwed up beyond all repair. And it is screwed up beyond all repair. So the system will go through a calculated bankruptcy with the replacement of a reserve currency by a global central bank currency, where gold will be utilized not in conversion, but rather in the manner of the school of thought called free gold. It's said very simply, the more gold a country has, the more attractive the currency is. This is the plan. Now, the problem with letting things go as they should go is a question of time, because we have a political transition in the making from the belief that the Republican Party were the guardians of deficits and sound economics, capitalism, and industrialism. And that's all. We have an election coming up where one party has adopted the extreme other approach. The entire party, everybody, nobody's. Deficits mean nothing. Spending means nothing. Debt means nothing. And the political ploy is not to let the present administration accomplish anything, i.e. Pelosi stays in California when she should be in Washington with her team trying to work out problems that exist. There's no workout. So it's been delay, interfere, delay, interfere, delay, interfere, and it's going to continue that way until the next election comes up to prevent the present administration from having much of an impact. Through presidential order, fiscal stimulation can take place. And you've noticed the recent merger between the Fed and the Treasury, and you must go back to who runs the Exchange Stabilization Fund and that is the President of the United States and the Secretary of the Treasury and or their appointees. So the purse now that used to be in the hands wholly of the Fed is no longer wholly of the Fed, but very much in the hands of the entity to be refinanced, the Exchange Stabilization Fund. And by presidential order, you could have fiscal stimulation, and you're going to have both with a historical degree of application, because the election is coming very quickly. And on one side, you've got those extraordinarily rich who want things to remain the way they are. On the other side, wealth is a sin. It's a use. The worker is downtrodden.
Unless
it's pure
Marxism.
Wealth,
Jim.
It's pure Marxism.
What did you say, Bill?
Time is the factor.
Okay, I said unless it's their wealth.
Yeah, well, the time is the factor.
Unless it's
but
theirs.
time is the factor. In other words, there's not enough time to do the right thing. Okay? Because the right thing will cause the wrong thing. If you did the right thing and things got going, you'd be right back in a banking crisis. You have an election coming in over, and politics rules the world. So it's coming too fast. So expect her to return to outrageous stimulation, outrageous market manipulation, done by the Exchange Stabilization Fund, and out of the Treasury, money going to the manufacturing concerns in a investment in the company, in other words, nationalization, and all of that failing in the very early years of the next administration, 2022, 2025. And it leads to 2032, which is the period of depression that we went through in 1929, right through to the war in the late 30s, early 40s.
Okay.
So if you see, the problem is time. And now I'm talking not from the standpoint of what should be done, not from the standpoint of quality thought. I am put myself in the position of being paid $1 billion a year to keep the facade together for the benefit of the 1%, and giving you an answer to what's coming from that standpoint. Not what I want to see happen, not what I believe is at all correct, but put yourself into the position of those that run the world. You think they don't know what's happened? I think they made it happen. They kept the playing board together. Now what you have to do is have the D numbers go down, and any recovery in unemployment, maybe just 50% recovery, and you'll have the market at least back to the old highs. And the present administration must be able to claim, I made the economy, and only I can remake it. Elect me or suffer the consequences. And it'll be elected.
We're getting a little bit long in our hour here. I got a couple more questions. Bill, I noticed that silver coins are at about a 30% premium over spot. You want to bring us up to date on the precious metals, physical markets, coins, bullion. What's the state of that market right now?
Well, what it tells you is that paper spot is fake. I mean, it's a convoluted fake number. Real silver does not change hands when paper contracts change hands. I can tell you that sovereign coins are very scarce. You can get bars, you can get generic coin, and the premiums are lower. You're looking at junk now is probably $21, $22. Maples are $23, $24, and eagles are $24, $25, $26, depending upon where you're looking. The premiums are huge, but I don't even think you should call them premiums, because that's where they're changing hands. That's the real price. I mean, and I've said this before on calls before, it's like the butcher shop that advertises $2.99 filet mignon, you walk in and there is none. And that's really what COMEX and LBMA are doing, is they're advertising pricing, but it's fraudulent pricing. Metal does not change hands at anything even close to what they say silver is. So.
Okay.
Denny, can I jump in there 1 sec, Denny? I just want to touch on that too. Bill, if the price was allowed to rise, the numbers would just start becoming multiples of what the price of silver presently is, because as the price started to rise, all of a sudden people would be like, oh, I got to get my hands on it. It's like the disappearing toilet paper.
That's human nature, yeah.
Right. So,
what you have something, you want it even more.
Well, and when you see the price of it rising, I mean, that's how we've chased Tesla stock and all these ridiculous stocks to ridiculous numbers. You want to see silver go to its true value, have the price suppression come to a stop, and then all of a sudden, as that starts heading up $20, $30, $40, $50, $60, people will be scrambling to get it, and then you'll have a real shortage.
Correct.
And that's going to happen. It's part of the plan. It's part of keeping the playing board together. Gold prices have been kept low so it couldn't be accumulated in the physical nature before they blow up the paper. And the price
that
rises.
was just what I wanted to add, Denny, because it's like the unemployment numbers. The unemployment numbers, forget about it. Because there's so many people out there in the gig economy or who are getting by being home contractors or whatever it was they're doing. They don't get to apply for unemployment. ADP doesn't pick those numbers up. ADP picks up IBM's numbers. But how much of the economy, when we were going just prior to the Christmas, when we were supposedly at full employment, how many of those people aren't even eligible for unemployment? So,
they'll extend it and increase it if required to get the present administration back in.
Jim, last question of the day. Miners that don't have debt and miners with good margins and miners with decent reserves are set to really do well in these sort of financial circumstances. As the price of gold is increasing, those margins increase by a huge amount. Bill gave me that lesson about a year ago. Right, and so the internal rates of return really are about to blast off.
Double.
Did I miss it, or is that still right?
Yeah. But bear in mind that if the United States was to nationalize by exchange for shares, the Canadians, all the gold companies that exist are incorporated there. Then the Secretary of the Treasury could claim the amount of gold supposedly held in storage as being real, since an audit done by yourself, the government auditing itself is not an audit; it's an exercise. So the amount of gold they claim to have, assume they have. Now, having by edict found their way into the gold companies in an exchange for shares, they now claim the amount of gold they have to be all the resources and reserves of every one of those gold companies, which will happen. And the pressure is not going to be to control the price of gold. The pressure is to let it go wild. And in the first reset, 3,500 is a good estimate. In the second reset, it will balance the balance sheet of whatever the reserve currency is. And I've just explained to you how the dollar can be kept looking well if how you look at it is through an index called the USDX, which is only a mirror where as you decline faster than the other currency, you're junior to it. And if you decline slower than the other currency, you're senior to it, i.e., the strong U.S. dollar. And again, I'm now being paid $1 billion in gold, or I'm getting the equal ounces of gold a year to guide the forces that would like to sustain themselves above the enormous shift to communism, not to socialism, to communism, that's taking place right now, where our voting is actually 50-50. That's where we stand right now. And where the swing vote will elect the president. And I'm going to swing so hard to stay in office that I'm going to set your hair on fire with the amount of money I'm about to put into the system in a different way. This is going to go as directly into the hands of the worker as could possibly be arranged. And the banking system will only need to be bailed if demand across the board picks up and is sustained, which is not going to be. So the Potemkin city will be remade of cardboard long enough, hopefully, to let there be no change in administration. I mean, that's the play. If I was paid to tell them what to do, I wouldn't do it, obviously, because it violates my ethics and principles. But I'm being realistic in today's conversation and pointing out to you that somebody somewhere, maybe Kudlow, has already made this analysis
Kudlow's
before
not
the
smart
epidemic.
enough, Jim.
I know, but just say somebody. Henny Penny, okay, has done.
Hey, Jim, in 2006, I think it was 06. The U.S. maybe it was 04. They reclassified held gold. They classified it as
class one asset.
Storage gold. And the
deep storage
means it's still in the ground.
Well, you can see the easy move and maintain the present management of the gold companies. The price of gold rising will make the stockholders so happy they'll be giddy. And what kind of opposition will the government get for taking 49%? And then claiming everything and anything that looks like gold, even fool's gold, is gold.
Yeah, and anything produced will have to be sold to the government. That's
correct, and that's why I'm in Africa. That's why there is nothing in Canada or the United States, in the sense of significant office and personnel. The center of the company that I'm running is in Tanzania, and the Tanzanian government doesn't have a contract with any company that is as kind and sharing with the government as the one I've negotiated, and also without any disrespect intended, we can run a gold mine. Tanzania once tried to run this gold mine, and you should read the report of the consultant they hired as to why the mine that we had was not successful at that time. They're not up. They have skill sets, but not mining.
We're about an hour, a little over. I've got some more questions, but it's probably a good time to wrap. Dave, have you got anything else you want to share with us before next week?
No, Denny, I don't. Again, let's just see what you can't say let's see what the next week brings, because one, there are no markets. As Jim has clearly stated, things are being done to make things not look like what they are. It's like the 0% interest rates. We saw negative oil prices. We're in uncharted territory. The rabbit hole just gets deeper, deeper, and deeper, and it just proves what we've been saying for a long time to people. Be prepared for crazy times, because, this is the craziest of the crazy. Is it not, Denny?
Oh, brother, yeah.
But somebody thinks it's the most logical of logical.
Well,
that's about
everything that's happening is very logical. The problem is we do not know the premises upon which this logic is being expressed. Everything that's happening is it's exactly right.
That's the basic command is maintain power. Therefore, power maintains wealth.
Wow. Jim, have you got anything else to share? You have been a wise one today. Thank you.
Well, I apologize for hypocrisy, but sometimes you got to put yourself in the position of the opposition in order to understand what's going before your eyes that makes no sense.
Bill, last man, not the last man standing, but the last man on the call. Anything else to say?
Congratulations again on you retiring. Jim and I were to do a interview with Greg Hunter yesterday, and Jim did it solo because I had technical problems, so everyone should...
Is that going to be the Sunday morning? Will that be Greg Hunter's Sunday morning call?
But it's not, Bill, that's not solo. That's my thinking, your thinking, Dave's thinking, and Denny's guidance, okay? I didn't do that solo. I just put it all together as we would have put it together.
You did. Hey, you taught us all, so...
Well, we'll be able to...
That.
Yeah, the fun part, we'll be able to listen to it. That'll be fun. Gentlemen, we will be back again next Saturday. That'll be Saturday the 16th. Ought to be a good day. Ought to be an exciting week. I'm not anticipating that we'll gather again midweek, but we're always prepared to do that. And to you, the listener, thanks for tuning in. There's an awful lot of stuff that's still there at that JS Mindset website. We'll encourage you to get there. And with that, you all take care, and we'll see you next week.